but we will start right now. It's actually 6:30. And as you can see, if you click on the panelist, people are literally logging in now that it's 6:30. So Hollis, why don't you take us away? And
Okay, let's get this party started. Good evening, everyone. I'm Hollis Wagenstein-Herturk. I'm the program chair for the New York City chapter of the American Association of Individual Investors. I am also now chapter liaison for all of AAII or AAII's 33 chapters nationwide. And I'm very pleased to present this evening a resurgence in value presented by Lynn Alden. And Scott, our president, will be introducing Lynn in just a moment. But to get started, I would like to acknowledge our chapter leadership, the board members who work behind the scenes to keep the lights on and the programs going. Scott, you've already heard from, our president. Paula Odellis, our treasurer. Nona Aguilar, our recording secretary. Shirley Sherrick, our facilities chair. Larry Dietrich, our communications chair. And you've already met me. This event is being recorded, and for all those AAII members who have registered for this event, you will receive a link to the recording within the next week or so. Now I'm trying to go to the next slide and nothing is happening. I don't know why.
maybe try clicking on there you go.
It worked. Finally, success at last. All right, we just want to tell you about the upcoming events. We usually hold our events on the second Wednesday of the month. For many years, it was the first Wednesday, but we discovered that there are many conflicts with holidays throughout the calendar year, New Year's, Labor Day, Memorial Day, things like that. So we're gradually making the transition to the second Wednesday of the month, and hopefully soon you'll reliably be able to mark your calendar for those days throughout the calendar year. Upcoming in April, we have JC Paris of All Star Charts. He's an expert in trading methodology. Paul Merriman, who is very popular on the West Coast. He's kind of like the eminence grise, or the elder statesman of financial planning and financial education. We'll have Rob Bernstein, who happens to be the chair of the San Diego chapter. He presented for us last year and it was a big hit. He's coming back to join us in June. And finally, Keith Fitzgerald, another West Coast presenter who is very well known on the West Coast. He was our speaker last July. For the first time in decades, we hold a summer meeting and it was a big success. So we asked Keith to come back and we'll be speaking with him again in July. One thing that you should know is that AAII is launching a new platform called Community to kind of enhance and enrich the way we communicate with each other. I'm going to attempt to post the link in the chat function, but I want you to know you don't have to try to copy down this extraordinary link here. We will be sending it out to you so you can access and sign in and log on. Among the new features that we have, and I'll be posting the link in the chat after I finish a few more introductory remarks, you'll be able to see the sign-in link so you can set up your account in the new community platform and access all the new resources that are going to be housed there. Now, there are just a couple of tips that will help you make the most of this event. Number one, we're going to ask that you hold your questions until the end, because the speaker may anticipate them and answer them in her remarks. The chat will be closed, and we ask that you don't put any questions there. The place to put the questions once the presentation has ended is in the Q&A tab that you will see in the center bottom of your screen. And we will read the questions back to Lynn so that the questions appear in the recording for people who'll be listening to it in the archives. And you'll also know what questions she is responding to. I think that's about it. And without further ado, I would like to turn the podium over to our chapter president, Scott Brewster, who will introduce Lynn.
Great. And thank you, everybody, for coming. And once again, if you are so inclined, we really would appreciate it. I'm posting in the chat just a link to make a contribution to our chapter. It really would be greatly appreciated for anybody inclined, because at some point we really need to, we're going to be trying to get back both in person and remaining to have stay online. And unfortunately, renting space in Manhattan is not cheap, nor there always are other costs going on with just doing what we do. So appreciate it. Also, we've launched a new website, AAIINYC.com, much easier to remember. If you can remember AAII and where we are, NYC, you've got it, AAIINYC.com. You can communicate with us there as well as make a donation. So again, right now we're going to be online through the summer, but we do look hopefully forward to being able to figure out how to get back in person. For the person who asked before how many people have signed in, like I said, people logged in while Hollis and I have been talking. And so now the number of participants is 53, which probably is a good number, as far as might be a little higher by the time I stop. So today it is my pleasure to introduce our featured speaker, Lynn Alden. Lynn Alden is the founder of Lynn Alden Investment Strategy, where she provides financial research to retail and institutional investors. With a background that blends engineering and finance, Lynn focuses on fundamental investing with a global macro overlay and covers a broad array of asset classes, including equities, currencies, commodities, and digital assets. Her work has been cited in the Wall Street Journal, Philadelphia Inquirer, CNBC, Business Insider, Morningstar, and other publications, as well as on popular podcasts such as Macro Voices, the Investors Podcast, and the Rebel Capitalist Show. Without further ado, Lynn Alden, thanks.
Thanks for having me. Are you able to see my slides that I've shared?
Yes, we are. Value versus growth.
Okay, perfect. And so we're going to talk about value stocks today, basically the value factor. And there's a bunch of different, obviously, definitions for value stocks. Different value investors have their own criteria. Generally, they refer to lower valuation type of companies that are profitable. Many of them pay dividends. If you get to deep value, generally a lot, fewer of them pay dividends, but overall, you're looking at ones that are more based on their current or near-term cash flow potential, rather than these long-out growth stories that maybe are not profitable now, but are expected to be profitable in the future. And in different decades, right, there are different macro regimes, and you're in some environments where growth stocks do better than value stocks on average, and other decades where value stocks do better than growth stocks on average. And so this presentation is going to talk about some of those dynamics, because some signs point to us at being somewhat of a turning point in these factor rotations. And so the slide I have on the screen right now is the Russell 1000 value total return level divided by the Russell 1000 growth total return level. And so what this means is that when the line's going up, that shows value outperforming growth. And when it's going down, you have growth outperforming value. And the gray bars are recessions. So this goes back to the beginning of the Russell indices, which is about 40 years ago. And so you can see during the 1980s, you had value outperformance. You generally had value stocks do better than growth stocks. So you grind it up over time in this index. During the 90s, during the growth stock, tech stock boom, you had the opposite. You had the line going down. You had growth stocks doing very well. And that really accelerated during the dot-com bubble, the very late 90s. And when you had the reversal there, when you had the crash of the dot-com bubble, the rise of the real estate, the banks, the commodities, the subprime bubble, you had a massive period of value outperformance, and that crescendoed into the subprime mortgage crisis. And then ever since then, you've had a period of growth stock outperformance that kind of culminated into the spike of outperformance during the pandemic, because everyone was working from home and tech stocks did very well. And so a general theme we have is that each decade tends to have a reversal, and those reversals tend to happen around recessions. Generally each one kind of a trend continues until something really big changes that trend, which is often major reversals in fiscal and monetary policy as well as the commodity cycle. And as you can see on the chart here, after the COVID-19 pandemic really accelerated a lot of growth stock outperformance. So you had the line going down sharply, similar to the dot-com bubble. Ever since then, it's been kind of chopping along sideways, double bottoming, you could say. And it's really kind of been in somewhat values favor. And so this presentation is going to explore some of the variables that could potentially lead that to continue going forward. And so, for example, if you look at a subset of this, kind of a different way of looking at the same question. This shows the S&P 500 energy sector total return divided by the S&P 500 total return. And again, whenever it's going up, you have energy sector outperforming, and whenever it's going down, you have the broad index performing. And so the 2000s were a very good decade for energy, whereas the 2010s were obviously a very, very poor decade for energy. And we had the infamous negative energy futures pricing levels back in April 2020. That was kind of the generational bottom, you could say, for energy prices. And now ever since then, we've been in a energy bull market. And a lot of this is due to the fact that commodities tend to go through these roughly 15-year cycles where when price is very low, nobody wants to put new capital into the market. You start to get limited supply. And then, of course, when prices are doing very well, because inevitably when you have tight supply, you get prices go up, demand keeps grinding up until you get out of supply. When prices are very high, a lot of new capital comes into the space and brings on new supply and pushes down prices. So commodities are these very boom bust industries, and they play a lot into whether you have value or growth performance. And as you can see here, so right now you can argue that energy stocks are overbought, right? I mean, energy hit very, very high levels during this conflict that we're seeing in Europe. But if you zoom out and look at the chart in these terms, the energy sector is really not overbought at all in the grand scheme of things. I mean, it has barely kind of gotten back to roughly the levels it was at the start of the pandemic compared to the S&P 500. So it's still kind of this long, kind of rebounding from a long downtrend. And to the extent that you have energy outperformance, you generally get value outperformance. They tend to be one and the same as far as the kind of the different factors are concerned. And so we can look at a couple different indices or a couple different stocks to have a valuation assessment, right? Because it's not just earnings that dictates whether growth or value does well. It's also the valuations that investors collectively apply to those stocks. And so this is a chart from Fast Graphs. It's a service I use sometimes. And what it shows is long-term earnings of the S&P 500 with 2 years of analyst forecast future earnings. And then it shows, so the black line is the S&P 500, and those blue and orange lines are basically average valuations applied to those earnings. And so the orange line would be 15 times adjusted earnings, and the blue line would be the average during this 20-year period, which happens to be 18.04 times earnings. And as you can see, going into the beginning of this year, the S&P 500 was very extended compared to its historical valuation as applied to these earnings. So during the pandemic, earnings went down, stock market went up due to all the liquidity, and then earnings rebounded in 2021. But by that point, the prices were so far ahead of those earnings that the valuations were still very high. And so currently, analysts have rather sluggish forward expectations for earnings, and valuations are kind of sagging down as we kind of go through this kind of slower growth period in the market. So that's kind of the baseline. And the S&P 500 is still overall very growth oriented. But this, of course, includes a mix of growth stocks and value stocks across the board. But just in general, it's growth oriented. And one of the reasons we get these big regime shifts, these big rotations in value and growth, is that, say, after a very disinflationary decade, the companies that are at the top of the index tend to be the types of companies that are very well suited to a disinflationary decade. And so they're, it's market cap weighted. And so when you then shift into a more inflationary regime, you often get pretty violent rotations where some of those really overvalued, expensive growth-oriented, disinflation-oriented companies tend to sag, while some of the completely left for dead, uninvested, under-owned types of value, inflation types of stocks generally have this strong rebound period. And then the same thing happens after a very inflationary decade. At the top of the index, you have all the energy companies and the banks and things like that. And when you rotate into a more disinflationary period, you tend to get that explosive kind of reversal towards growth-oriented equities that at that time are under-owned. And so this is kind of, I think what we're seeing here is somewhat of a transition away from these kind of over-owned growth types of companies. If you look at an example of a growth stock, this is Cadence Design Systems. They make software for engineers. Actually, before I kind of began focusing on financial analysis, I was an electrical engineer, and I've actually used some of their software. It's a great company, very good service, obviously strong growth. They transitioned from selling one-time software to selling software as a service, which has been very good for the company. But as you can see here, despite the fact that the earnings have done very well in recent years, the stock price has done absolutely incredible, just completely disconnected from the earnings. At one point, they got up to well over 50 times earnings, even though future growth did not necessarily justify that level of valuation. And they've come down considerably in the past several months, but they're still rather elevated in terms of valuation compared to their past. And the purpose of this is not to really focus on these individual companies, right? So I can't really tell you for sure what Cadence stock is going to do in the years ahead. But the point is to give a representation of what a lot of growth stocks look like. And so, a lot of them are still, despite the pullback, despite the recent value outperformance and the struggle with growth, a lot of them still are rather expensive compared to their history. And this is no exception. So they're currently trading at well over 40 times earnings compared to their average of 25 times earnings. And you can argue that some degree of higher multiples justified by the fact that they've shifted towards more of a software as a service model. But it's hard to argue that there's a ton of margin of safety in a name like this at this type of valuation. On the other hand, if we look at many value stocks, we actually have pretty good compelling opportunities. And so this is Cigna. They're a large health insurer. They also are a pharmacy benefits manager, one of the largest companies in the world by revenue. They're profitable. They initiated a dividend about a year ago, and then they increased it by over 10% this year. And so they're kind of beginning their journey as a dividend growth stock. And what's interesting is if forward analyst expectations give them almost as much growth as Cadence, but instead of trading at over 40 times earnings, they're trading at more like 11 times earnings. And they unlike Cadence, they pay a dividend. And so if you look at a lot of value stocks, this is actually what they look like, where they're not really overvalued at all. Some of them are undervalued, some of them are fairly valued. And so this type of valuation analysis would argue that the opportunity set going forward over the next 5 years still probably favors value over growth. And so that won't be true for every name. And I'm not really kind of, trying to highlight individual stocks here. But the point is to kind of come up with examples. This is another value example. So this is Suncor Energy. It's a Canadian energy producer and refiner. They've had some operational challenges, so they've not done as well as some of the other energy companies. But overall, despite the fact that energy is now doing very well, this has been a laggard. And analysts are quite favorable about their forward prospects, and the company is also able to pay a pretty large dividend and buy back a lot of its shares at a cheap valuation. And so again, this is an example of a value stock that is hard to argue is overvalued. Whereas if you go back to something like Cadence, it's hard to argue that is cheap. You can argue that it's maybe it's going to outperform analyst expectations, maybe it's not overvalued, but it's hard to argue that it's super cheap. Whereas some of these value-oriented equities are easier to argue that they are appropriately priced compared to the forward potential. And so it kind of gives more weight to the idea that we're still probably in a pretty good period for value-oriented ETFs, value-oriented stocks in general, compared to the more growth-oriented investments. And if we zoom out, I mean, let's look at the value, let's look at the macro picture for a second. And so this is a set of charts that I've been showing and updating for a period of time for the past 2 years or so. And it shows some of the fiscal and monetary dynamics that can impact some of these. And so the chart on the left there is the blue line is federal debt as a percentage of GDP, and the orange line is non-federal debt as a percentage of GDP, which is mostly private debt. It also includes a little bit of state debt, but the vast majority of it is private debt. And what this generally shows, and I've kind of been arguing for a while now, is that the 2020s look a lot like the 1940s in terms of fiscal and monetary policy. And so going into the late 1920s and the early 1930s, you had the end of a long-term private credit cycle. Basically, you hit zero interest rates. You had a private debt bubble, and then you went through what was essentially a decade-long deleveraging. And became a depression because you had other factors that made it even worse, including things like the Dust Bowl. And when we fast forward all the way to 2008, there's actually a pretty similar dynamic. So you had a structural deleveraging happen in the private sector. It's still a pretty mild deleveraging compared to how high it did come down in terms of debt, but it's still considerable. And generally, what you have is during a deleveraging, you generally have federal debt increase as they try to offset all of the slowing of economic growth and depression type characteristics you could have in a deleveraging. And so they kind of transfer debt from the private sector to the public sector. And so we're kind of in that similar dynamic now. And when you look at the chart on the right, you can see that's the monetary and fiscal policy around those same time periods. And so when you enter the early 1930s, you hit zero interest rates. And again, you hit zero interest rates in 2008. And so the orange line there is short-term interest rates. And the blue line is the monetary base as a percentage of GDP. So that's base money. And as you can see, when you would hit zero bound in terms of interest rates, you resort to very different types of monetary policy tools. And so, you have this, again, this argument that in many ways, the 2010s were a lot like the 1930s. And in many ways, the 2020s are shaping up to be a lot like the 1940s. And so this, if anything, I've been making this comparison for the past couple of years, but it got a little bit more direct with the recent conflicts over there in Europe. So this doesn't necessarily refer to war, but it refers to war-like types of financing. We have very, very large fiscal deficits, and you have very, very large public debt as a percentage of GDP. And this, the reason I'm tying this in, you'll see in a little bit, it kind of refers to some of the growth and value dynamics that we see in the market. One of the factors to look at is, so a lot of people, when we see the inflation that we're seeing today, right? So 7.5% official inflation, commodities, doing very silly things in terms of price. A lot of people think of the 1970s. And in the 1970s, if you go back to this prior chart, actual debt was very low, especially public debt. So debt was low. And so in some ways, it's not the best comparison, because when you had these very high inflation levels, like I showed the blue line here, the Federal Reserve is able to raise interest rates and try to contain that inflation, because debt was low enough that if they raise interest rates, they wouldn't cause widespread insolvency. They would just at worst cause a recession. And so when you had these waves of inflation throughout the 70s, the Fed was able to try to contain it. And eventually had Paul Volcker come in and he jacked interest rates up super high and was able to quell inflation. When you go back to this other chart, though, this is the inflation that we saw in the 1940s. And so the blue line, again, is the inflation level, and the red line is short-term interest rates. And as you can see, there's a complete decoupling of inflation and interest rates. And so what you had was very, very low interest rates and very, very high inflation. And that was because, federal debt was so high that they couldn't afford to raise interest rates, despite the fact that you had high inflation. And so instead you had debt monetization and you had pretty sharp currency devaluation. And one thing we've been seeing is that so far in the 2020s, we're seeing a similar dynamic. We have a complete disconnect between inflation, which I show here in blue, and short-term interest rates that you have in purple, and even long-term interest rates in orange, which again is what you saw in the 1940s. And so this kind of strengthens the comparison between the 2020s and the 1940s. It's just something to keep in mind when you go back to the value and growth dynamic. And so if I bring back part of that chart, that prior chart, we have these long-term dynamics, right? So when you enter this kind of crazy period of the 2010s versus the 1930s, right? I highlight those because this chart here is from Real Investment Advice, and what they show is the 5-year correlation, the 5-year rolling returns, I should say, of value versus growth as a factor, and that goes all the way back to the early 1930s. And so when that's positive, when it's green, you generally get value outperforming growth, and when it's red, you get growth outperforming value during those rolling 5-year periods. And over the long run, value generally does better than growth. Basically, the habit of buying, under-owned, cheap type of stocks generally does pretty well. But there are 5-year periods and sometimes even 10-year periods where that's not the case. And the longest periods where you had trouble with value stocks, the first one was the 1930s, which is this box here. So you had, you hit zero interest rates, you had a private sector deleveraging, you had an expansion of the monetary base. And the other one was the, most of the 2010s. And again, you had this same macro dynamic. And so those were very unusual periods that I would characterize as being part of the same part of the long-term debt cycle. And so if the idea is correct that we've kind of exited this period and now we're kind of more in an analog that's kind of similar to the 1940s with more inflation and more kind of fiscal driven policies, you can argue that we're probably exiting that period of growth outperformance and getting more again back into a period of value outperformance. Now, that does not mean that I would not own growth stocks. And so, for example, here I show some of the most growth-oriented types of equities, which is the unprofitable growth sector. These are, often owned by, for example, the ARK ETF. They got pretty famous in recent years. And what this shows is Twilio and Roku. These are two very fast-growing, unprofitable companies. The purple lines are their quarterly revenue numbers, and the orange lines are their price to sales ratios. And as you can see, they continue to have structural growth. And in early 2021, they hit very, very high valuation levels. So they hit over 30 times revenue, not 30 times earnings, but 30 times revenue. And that was, of course, rather bubblicious. And as you've had this big rotation into value, these companies continue to grow, but their multiples contracted massively. So many of these, types of companies had 50, 60, 70% drawdowns in terms of price. And generally what that took the form as is that, their price to sales ratios would collapse from, say, 32 times sales to 8 or 6 times sales, which is still somewhat rich in terms of other companies, but it's pretty reasonable for companies with this level of growth. And so actually, I do find in these oversold types of names that there are interesting opportunities there in the growth sector, but I'm rather cautious of that whole kind of growth factor when looking at a very broad level, and especially when looking at the mega caps, the ones that have rather high multiples, but that are slowing in terms of growth. And so if I were to conclude this presentation overall, I would say that the valuation characteristics of the market generally still favor value-oriented types of companies, and the macro environment, with kind of more commodity scarcity, more fiscal type of kind of a fiscal heavy environment globally. Those types of conditions generally favor value stocks over growth stocks. But that it's not across the board, that there are pockets of opportunity in the growth factor, and that things can become oversold for periods of time. These ratios can get overextended for periods of time and give contrarian investors opportunities to get back in to the ones that are underperforming. And so I think there's somewhat of a barbell approach that can work here, where you have, say, an emphasis on these value-oriented names, but then dabble in some of these, kind of mid-cap, unprofitable, hyper-growth type of companies when, at the exact periods where nobody really wants to own them. And so I think that those together contribute to a rather diversified portfolio. And I'll stop here because I can leave a lot of time for Q&A to talk about some of these various value and growth-oriented factors going forward. Thank you.
Lynn, let me start by thanking you. This was an amazing presentation, and in a way, it was unique from many of the types of programs we offer because you provided both a lot of content and context. We got the details and we got the big picture. And I think it was remarkable in that respect. And I've been getting some questions from listeners. They want to know, will they get the recording? And I want to reassure everybody who's online right now, everybody who registered for this event, who's a member of AAII, will receive a link to the recording. The recording link will also be posted on the chapter website and other places on the AAII national website, including the community platform that I was talking about earlier. So I want to give people an opportunity to place their questions in the Q&A box. Just click on the Q&A link. It looks like a cartoon dialogue thing in the bottom center of your screen. And I will start reading the questions to Lynn, so they'll appear in the recording and you'll know what's going on. Okay, our first question comes from listener Jeffrey Landau. He asks, what is the cutoff definition between value and growth stocks? Are the three cuts, I'm reading it verbatim, value, growth in the middle?
So the way, it depends on the index provider, right? So if I look at this chart here, Russell, they don't segment the market into two different. So it's not like two totally separate groups. You can technically have a stock that qualifies as both a value stock and a growth stock. For example, if it has growth characteristics but is priced at a value stock, it can fall into both categories. Generally, what Russell would do is look at valuations in terms of their value factor and look at growth aspects for their growth factor. And so for the most part, when you're looking at value stocks, you're looking at a pretty big chunk of the market, kind of the cheaper half of the market roughly. And then growth stocks, you're looking at generally the more expensive aspect of the market. But there is a big middle ground where you have kind of growth at a reasonable price stocks, where you might have, say, 10% revenue growth and maybe 20 times earnings, right? So you're generally getting a pretty good amount of growth for the multiple that you're paying. I personally, so I when I do charts like this, like these broad indices, I rely on things like Russell's definition of value, which I might or may not agree with, but it's kind of, if you were to just kind of draw a line somewhere, Russell and S&P 500 have these definitions. But when I go more granular, that's when I like to look at individual companies, because I can say, okay, an index is interesting, but somewhat arbitrary. And so I want to know what individual companies are doing, which is why I dive into stocks like Cadence or Cigna. And when I make investment decisions, sometimes I use ETFs, but I also use individual equities. And so I find areas that are interesting. And so when I then break into the indices or the ETFs and I say, okay, what is the healthcare sector doing? What is the banking sector doing? What is the software sector doing? I kind of go into those different areas and find what's happening in terms of valuation and what's happening in terms of analyst growth expectations. And so I don't kind of focus too much on these definitions of growth and value, and instead I like to look at individual companies and kind of finding things that are appropriately valued for the growth that they offer and the other aspects like their balance sheet strength, things like that.
Thank you, Lynn. Now we have a question from Cloud Molosui. Please forgive me if I mispronounce your name, Claude. He asks, is there any particular value sector you find most attractive? Do you favor domestic versus international value?
So generally, you can get a little bit better value if you look international, but you also have more volatility because if you're translating them back into dollars, you have stock risk, and on top of that, you have the currency risk. And so generally right now, U.S. stocks are over-owned by both American investors. So American investors are underweight international stocks compared to the average, and international investors are overweight American stocks. And so you can certainly make the case that we're probably in for a period of international outperformance, but that's not guaranteed. That can be derailed by all sorts of things. As we're seeing right now, for example, Europe is being hit by an energy crisis more severely than the United States. just because of their energy policies and some of the geographic realities over there. And so there is a case for international value. I think, for example, there are very cheap, very kind of deep value Latin American equity opportunities out there. What was I think there's the first part of that question. What was the first part of that question? I think I answered half of it.
The question is lost to history, unfortunately, because once we start answering it, it leaves the screen. But possibly the
oh, I can see it. I found it. So the first part of that question was any particular value sector you find most attractive. And then the second part was domestic versus international. So I guess getting back to the first part, I find, I can segment it into defensive value versus cyclical value. And so I find from the defensive value standpoint, healthcare is pretty attractive. So if I get into the Cigna example, that's an example of being, healthcare in general is pretty attractive across the board. When I look at cyclical value, even though it's probably overbought in the near term, I'm pretty structurally bullish on energy and commodity producers. And so that's kind of an area that I find rather attractive from a value standpoint. I also like looking at the energy pipelines because they're less overbought, they're less priced, they're less tied to the prices of the underlying energy, and instead they're really based on volumes. And so you can get very, very high and rather safe at the current time distribution yields from some of the midstream companies. A lot of them had blowups in the past, they were over levered, but due to many years of challenges, a lot of the ones that are still standing are actually rather low leverage and have a lot of cash flows to back up their distribution. So I think we answered that question.
Thank you. We have a listener who asks, he asks you to circle back to fast graphs and please define GDF and the P/E equals G equation.
So fast graphs, depending on the amount, how much growth that company has, they will calculate the orange line slightly differently. And so what, generally, if it's a middle growth stock, let's say Cigna, they'll generally just define that as 15 times earnings. And whereas if it's a faster growing company, they will realign the orange line so that the multiples equal to the average growth rate of the earnings. And so it basically assigns it to a PEG ratio of 1, price to earnings to growth. And so, on FastGraph's website, they have, and I'm not affiliated with them in any way. I just find their service useful. But they have, kind of a detailed overview of how their various calculations work.
Thank you. Steve Duncan asks, at what point will Russia be a value investment?
Well, so going into this, Russia was already undervalued compared to the rest of the world. Generally, you could get pretty low debt, pretty well-run companies at bargain multiples. Now, because of the war, because of the issues that are happening there, a lot of them are currently uninvestable to Western investors. Moscow Stock Exchange is closed. There's sanctions. Many brokers won't let you trade them because they don't have liquidity in the markets. And so that really kind of depends on Putin. It kind of depends on what happens with the sanctions and what happens with the war. Right now, it's because it's almost uninvestable. It's hard to define it as a value investment. I think there are surrounding regions, like you can buy the Poland ETF, for example. They, a lot of their stocks were cheap. They've crashed from cheap levels. They're part of NATO, so they don't really have the same dynamics as Ukraine. And so there are kind of surrounding, kind of contrarian, buy when there's blood in the streets types of investments. But Russia itself is very challenging just because no matter how cheap it, I mean, right now it's so cheap that it's, silly, but you have things like, Russia blocking international bondholders from receiving interest payments. They can nationalize companies. They can block dividend payments to foreign nationals. And so it's in many ways out of balance compared to a normal value investment.
Thank you. One of our listeners asks, what value stocks or ETFs or mutual funds would you recommend at this time? And do you have a list of those on your website?
So yeah, I have model portfolios that include a number of different ETFs and individual stocks that people can check out if they want to. I have a free newsletter, and also I have a low cost research service. So depending on what people's budget are, there's a couple different options there. Um, in general, I like the equal weighted S&P 500 ETF. So there's RSP. That's an option. It's not specifically value oriented, but basically it doesn't really follow the same kind of market cap overweighting that the normal S&P 500 does. So I like that a little bit in this environment. And so in general, I tend to avoid value ETFs, although there are some good ones, and I pick individual companies. So I like names like Cigna. I like names like Enterprise Products Partners. There's a bunch of kind of value-oriented equities that I purchase.
Lynn, there appears to be a lot of interest in your products and services. James Morlock asks if you could tell us about your newsletter, your website, and the services your company provides to individual investors. And another reader, Hayden Huang, asks, well, he comments, I've read a few of your articles about Bitcoin and crypto. Cryptos have been treated as high PE growth stocks and took a pounding. What's your opinion on cryptos as an investment, these going forward as a value opportunity?
Sure. So from my website, lynnalden.com, basically it's a couple different things. It's partially it's a blog. So we have long form public articles on, different topics. And then there's also a newsletter that comes out every 6 weeks. It's a free newsletter, kind of a long form research piece on a more kind of a time sensitive topic. It could be energy shortcomings, could be valuations in the market, could be kind of regime changes we're seeing. And so that's a very popular reading. And then we do have a low cost research service that comes out every 2 weeks. And it's similar to the free newsletter, but 3 times as often, and updates a variety of model portfolios that investors can follow. And so depending on how granular they want to be, we provide, most of our content is free. Most of it is talking about the macro factors, whereas people that want that more frequent update or more stock specific research generally subscribe to the premium research service. As for crypto digital assets, I do cover Bitcoin and cryptos as part of the digital assets coverage. And so in general, correlations work until they don't, right? So Bitcoin had this period where it was very heavily correlated to the 10-year treasury yield, for example, until it completely diverged from it. In addition, in recent months, over the past year, really, it's been very heavily correlated to the high growth equities. And so, for example, Bitcoin peaked around the same time as the ARK ETF peaked. And it's been in a struggling really kind of over the same time period, although it has held up better in terms of drawdown than the ARK ETF. I kind of view Bitcoin as kind of a hybrid between a growth stock and a commodity. And so in a value-oriented segment, in a value-oriented kind of macro regime, commodities do very well. And part of that's because, when you have inflation, almost by definition, you have a strong uptick in commodity prices. And when you have a big uptick in raw materials, when you get an uptick in wage growth, you get pressure on company margins. And so when company margins are pressured, they obviously grow slower, especially in inflation adjusted terms. And then investors are often less willing to place high multiples because they have less certainty or less forecasting ability for what their earnings are going to do. Now, something like Bitcoin doesn't have that problem, doesn't worry about profit margins, doesn't worry about wages, doesn't worry about material costs going into it. And so in many ways, it has that commodity oriented aspect to it. So I view it somewhat of a separate from that growth and value orientation. One correlation you can look at is that when you have a rising PMI environment, so Purchasing Managers Index is going up, when you have economic growth is accelerating, usually Bitcoin as a rather high volatility asset generally does pretty well in that environment. And when you have a falling PMI environment, economic deceleration, Bitcoin historically has done rather poorly in that environment, at least in the 13 years of history that we have for it, which is not a ton. And so right now, we're in a falling PMI environment, and we have been since late last year. And so it's not that surprising that Bitcoin has been in this kind of choppy period. And so when you do get back to a rising PMI environment, whether it's a growth or a value-oriented kind of period, I would be rather bullish on Bitcoin in that environment. Whereas in the near term, I'm kind of more uncertain about it because it is kind of a risk-off environment, and that's challenging for such a high volatility asset.
Thank you. Here's an interesting question. Starts with a comment. International, especially emerging markets, have been underperforming for more than 10 years comparing to the US. Does the fact that the US dollar is the world's reserve currency give it an inherent advantage to the US markets?
Yeah, so when you look back over the long term, generally each decade has a different period of outperformance. And so, for example, in the 1980s, for example, you had foreign developed markets, particularly Japan, outperform. So without the reserve currency, they were massive outperformers. In the 90s, you had the US outperform. So that was an example of the reserve currency country outperforming. In the 2000s, you had massive emerging markets outperformance. They absolutely crushed US stocks. And obviously they did it without the reserve currency. And then, as you point out, during the past decade, the 2010s, US stocks really outperformed emerging markets. And so I would say that that is somewhat disconnected from the question of who has the reserve currency, because during that whole period, the US had the major reserve currency, and it had structural periods of underperformance or outperformance. One dynamic that the reserve currency has, at least as currently structured, is that because oil internationally is mostly only priced in dollars, although in recent years that seems to be changing to some extent, it's being priced in more than one currency. But for the most part, over the past 40 to 50 years, if any country wanted to import oil, they needed to pay in dollars, which it basically meant that every country in the world needs dollars, right? So we have a higher monetary premium on our currency than other currencies. And that sounds like a good thing. And for a lot of participants, that is a good thing. But it also generally means that our import power is stronger and our export competitiveness is weaker, right? So our products and services tend to be more expensive for their level of quality than we would expect from other peer nations like Germany and Japan and other countries like that, let alone emerging markets like China. And so the US has run structural trade deficits for decades now. And that's generally how we get dollars out into the world. And so that is very good for markets because all those trade deficits go out into the world, and then investors take those dollars and then they plow them back into US capital markets. They used to buy treasuries, and now increasingly they buy US stocks. And so, for example, the Swiss National Bank buys Apple stock with some of its current account surpluses that they get. Now, that could eventually end, right? So eventually it gets so extended and so much capital gets shoved into US markets that basically everybody's on the same side of the boat, and that can reverse. So I do think that there are risks in that eventually reversing. So there's nothing about the reserve currency that means that your stock market has to outperform. But in this specific environment, this kind of multi-decade period, it has been a long-term tailwind that I think in over the next decade might start to reverse and might be challenged. So I am kind of rather cautious about broad US stock indices compared to some of their international peers.
Thank you. Do you have a view on the future direction of the economy, given the high inflation environment we appear to be in now?
So even prior to this recent spike in some prices due to the war, we were seeing that purchasing managers indices were rolling over. So we're getting a period of economic deceleration. That's a combination of multiple factors, including pullback of fiscal stimulus, tightening of monetary policy, and just in general, kind of coming off of a sugar high that we experienced over the past couple of years due to all the stimulus. And so I see a period of economic softening either way. And when you do get that high inflation as well, that can make it rather stagflationary because, for example, if we have energy shortages and we have high energy prices and high commodity prices in general, that means consumers have to spend less elsewhere. And so that can be very challenging. So I am rather cautious on a variety of assets. I generally have a rather defensive outlook, especially in inflation adjusted terms. So, even in a defensive environment, in a stagflationary environment, stocks might chop around and go sideways. Maybe they go up a little bit, but when you inflation adjust it, it tends to be rather poor. And so I am rather cautious about a lot of stocks in this rather inflationary environment. And in general, in inflationary environments, value stocks, obviously commodity stocks generally do pretty well. Some of them can get overextended for a period of time. So when something gets too popular, I'm rather cautious about it. But I still think there's a really good chunk of performance left in healthcare stocks, energy stocks, commodity stocks, energy transporters. I think there are attractive assets out there, even if the US economy and parts of the world economy do slow down significantly.
Thank you, Lynn. Very many people really appreciated your presentation. The way we know, in fact, is that everybody stayed to the end. Nobody logged off during the Q&A section. And you've been getting some compliments, people saying that your presentation was very efficient and informative and that they enjoyed it. Some people want to stay in contact with you and they asked for your website. Since I personally have it on speed dial, I'm guessing you're going to say lynnalden.com.
Yes, it's lynnalden.com. So that I have it here. So LYNALDEN.com is the website that I operate.
And I put it in the chat as well.
Okay, thank you.
I think you've covered all the questions that we've asked, and
I don't know if we lost you, Hollis, but looks like we came to the end of the presentation. There you go.
Sorry about that. I dropped one of the buttons here. I'm very sorry. I wanted to thank Lynn and tell her that we're planning to bring her back for some fireside chats and an encore presentation in the future. Just about everybody stayed to the end, which is rare. So they must have been really captivated by the information she had to share. The recording will be out within the week. And we invite people to participate in the kind of the after party, the post-event discussion. The link is posted in the chat section. And I saw a couple of things come up in Q&A. I want to see if we missed anything. Fabulous presentation. Thank you very much for an informative presentation. It really resonated with our members, and I want to give you a final thank you, Lynn, and look forward to staying in contact. I'll let you have the last word, Scott.
No, that fantastic presentation made me want, even at this late hour, go and look into a lot of the stock ideas, and that's what a great presentation is all about, stimulating one's curiosity and learning. So I appreciate that, and I'd look forward to another opportunity to hear you again. And what a great website as well. So anybody who hasn't checked it out, go to lynnalden.com.
Okay. Lynn, you're our newest chapter champion, our favorite presenters. So thank you so much for your presentation, and we look forward to staying in contact. And at this point, we'll say goodnight to everybody. Happy trails, and we'll look forward to seeing you next month.
See you next month, everybody. Thank you.